I'm Greg Hunter. Welcome to USAWatchdog.com. We're very happy to have on as a return guest. He's been on a ton of times, four times, as in one, two, three, four best-selling author, four in a row. We have his Case for Gold. We'll talk about that. His Road to Ruin. Talk about that. The Death of Money, and also another huge runaway bestseller, Currency Wars. His upcoming book is called Aftermath. This is the galley copy. I'm talking about James G. Rickards. James Rickards, thanks for joining us today on USAWatchdog.com.
Great to be with you, Greg. Thank you.
We'll talk about this in just a minute because evidently we're going to need to. It's the aftermath, the 7 secrets of wealth preservation in the coming chaos. And evidently we're going to need that because I think the Fed thinks there's a coming chaos because they just came out, which I think's almost bizarre, covering financial stuff for the last 10 years. And I've never heard a Fed come out and say, okay, we're not going to raise rates for the rest of this year and one time in 2020. What is going on, James Rickards?
Well, reality has caught up with the Fed. And I think listeners and viewers understand. I've been saying for 2 years, actually a little bit longer than that the Fed was tightening into weakness. The economy was not as strong as, the cheerleaders say, not as strong as the White House says. That it was fundamentally weak. The global economy is worse, so I'm not picking on the United States. We're doing a little better than a lot of our trading partners and other major economies, but the economy is weak and the Fed was tightening into weakness. Now, there was a reason for that. They were not tightening for normal business cycle reasons. And just as a kind of quick reminder of how things work, the Fed's always behind the curve, by the way. The Fed never leads the economy. They always follow the economy. So what happens in a normal cycle? The economy gets better, labor markets get tight, capacity gets tight, inflation ticks up a little bit, and the Fed says they're watching, and then finally they say, okay, gee, we got to do something. We raise rates a little bit. Inflation continues. They raise them more. So they're chasing inflation, but eventually they tighten too much, and the economy weakens. Unemployment goes up. Capacity utilization goes down, inflation goes down, turns into disinflation. The Fed's watching, and they say, oh, now we need to ease. And then the whole cycle repeats itself again. So that's a normal business cycle, Fed tightening, Fed easing process that's been going on 20 times or more since the end of World War II. The reason this time is different, and I understand as soon as you say things are different, you get in trouble, but this time it actually is different, is the Fed is not tightening because the economy is so strong. Inflation is nowhere to be seen. The economy is fundamentally weak. Best estimates as of now is that the first quarter of 2019 will be a fraction of 1%. The two best estimates out there are showing it at about 0.5%. So extremely weak, borderline negative growth, borderline recession. But that's not why the Fed was tightening. They were tightening to get ready for the next recession. Evidence shows, economic history shows that you need to cut interest rates somewhere between 4 and 5% to get out of a recession. How do you cut interest rates even 4% if you're only at 2.25%? The answer is you can't. You have to get to 4% before you can cut 4%. And that's what the Fed was trying to do. But the conundrum was, how do you raise rates in weakness to get ready for the next recession without causing the recession that you're preparing to cure? That was the conundrum. I never thought they'd get it right. And in fairness to them, it's a pretty difficult task. And as of now, it looks like they didn't get it right, meaning they tightened so much to get ready for the next recession that they slowed the economy. And it's important to understand, Greg, that monetary policy works with a lag, so of 12 to 18 months. So the slowing that we're seeing right now today in the first quarter of 2019, that slowing is the result of interest rate hikes in 2017 and early 2018. The interest rate hikes in late 2018, including December, plus quantitative tightening, we'll talk about that in a minute, we're not going to see the effects of that until later this year, early next year. So the fact that the Fed at the end of December decided to pivot to a kind of ease, they're not cutting rates, they're not ready to cut rates yet, but just putting them on pause, that's a Fed concept. Pause just means we're not going to raise them this time, and they didn't raise them in March. Obviously, no one expects that they're going to raise them in June. I think that's right. But just putting rates on pause is not enough to get the economy out of its funk, because that won't really have any impact until maybe early next year if they're lucky. So they did tighten into weakness. They did come close to causing the recession that they were trying to cure, which is not what they wanted to do. Now they backed off, and maybe we'll escape a recession by the skin of our teeth. But it just goes to show the box that the Fed is in. And just a word on quantitative tightening. You know, a lot of viewers, they were all spun up on quantitative easing, so-called QE, money printing. The Fed took its balance sheet from $800 billion to $4.5 trillion between 2008 and 2014. It's a lot of money. And they were expecting massive inflation, a lot of other things. That never happened. We never got the inflation, because inflation doesn't really have much to do with money supply. It has to do with velocity and psychology, but that's a separate subject. But the Fed decided that they needed to normalize the balance sheet, meaning they needed to come down from that 4.5 trillion down to something unspecified, but maybe closer to 2.5 trillion. Why were they doing that? That's called quantitative tightening. You're actually burning money. You know, during the QE, there was a famous cartoon that got circulated. It showed Ben Bernanke was, hanging from the strut of a helicopter with a manic smile on his face, throwing dollar bills out the helicopter. That was an image of QE, quantitative easing. Now imagine Jay Powell standing next to a furnace with a large pile of $100 bills, shoveling the money into the furnace and burning it. That's QT. He's not printing money. He's destroying money. That's how the Fed reduces the money supply. They just they just sell bonds to the market or let them run off. Don't buy new ones, and the money just disappears. So that's what we have now. But that's another form of tightening. So the Fed was double tightening until last month. They were raising rates, and they were reducing the money supply. So it was a double shot of tightening, and it's no surprise that the economy slowed down. The other thing the Fed announced the other day, in addition to not raising rates and lowering their economic projections, is they're getting ready to reduce QT. They're going to reduce it by half starting in May. They were burning $50 billion a month. $50 billion a month, $600 billion a year. That's how much of base money supply was disappearing. And they're going to cut that in half to $25 billion a month, and then end it in May, by which point their balance sheet will be down to around maybe $3.25 trillion, $3.5 trillion, somewhere in that vicinity. So they're double easing, right? They paused on rates, and they're going to pause on QT and see what happens. I don't think it'll be enough. I mean, they're going to be under pressure to actually cut rates, but they won't cut rates until QE stops. So you're not going to see a rate cut before September, but after September, when I said, Billy, I think I misspoke. I said QE. I meant to say QT.
QT, yeah. Quantitative tightening.
When QT, quantitative tightening, stops in September, then they're going to take a look. And if the economy's still weak or certainly declining, then they're going to have to look at rate cuts. So this whole thing, by the way, this is all I lay at Ben Bernanke's feet. Janet Yellen continued it. Jay Powell continued it in some ways. But this was Ben Bernanke's invention. I mean, you have to understand, quantitative easing of the kind we saw had never been done. Since the Fed was created in 1913, this was completely unprecedented. So you can think of it as a science experiment, which it was. I spoke to Bernanke about this, and he admitted it. Well, quantitative tightening, that was getting out of what you got into, is another science experiment, because that's never been done before either. How is it the case that they printed money for 7 years and inflated asset values, but now they're burning money, but they don't think asset values are going to decline? Of course they're going to decline. It's just the inverse. So Jay Powell is in a tough spot. I will give him credit for realizing the difficulty before it's too late, but maybe it is too late, and that's really the point. Bernanke, painted the Fed into a corner. They can't get out. There's no escape from the room. By the way, one of the reasons gold's performing so well, the Fed has proved that they can't get out of this. They got into it, but they can't get out of it, because every time they try, they sink the stock market, they sink the housing market, they raise the specter of a recession, they slow economic growth. They don't want that. So they sort of pause and then maybe tiptoe back into it, but they really can't get out of it.
Which brings me to, I wanted to talk, I've been polling people on this, and some people are like, wow, this is a big deal. And other people are like, eh. And so I want to get your thing on this about gold becoming a tier one asset at the end of March, which means it's 100% valued. It's basically remonetized. It's not held at 50%. I know you know all this. But what about gold being now, all of a sudden, after all this Basel III, and we've had a 7-year run to make gold 100% valued on banks' balance sheets? Is that a big deal?
Well, look, it's a step in the right direction. I think it's symbolically important, but I don't think that by itself, at least in the short run, is going to have much impact on the price of gold because U.S. banks aren't going to use it. In other words, are they allowed to? Yes. But the only banking system in the world that I'm aware of that's actually using gold, where the banks have gold on their balance sheets, and yes, it's a good tier one asset, is Turkey. I'm not aware of any major banking system that's doing this. Of course, the central banks have gold, or at least their finance ministries or treasuries do. So is it, again, is it a significant development? Legally, yes, it's interesting. I do follow it, but it's not going to have much impact on the price of gold because when you look around the world, 60% of global reserves are in dollars. 80% of global payments are in dollars. Almost 100% of the oil market is in dollars. The U.S. banks are obviously dollar denominated. They run the international monetary system alongside the Fed, and they're not actually going to use it. If I woke up tomorrow and J.P. Morgan said, "Hey, we just bought 100 tons of gold, and it's in the vault, and it's on our balance sheet, and it's a good tier one asset," that would be bullish for gold, but I'd be shocked if it happens. Yeah, it's an interesting development, but not significant to the price of gold because no one's going to use it except for very few banks.
Well, can we add in there yet? Because what it sounds like to me, if the Fed can't get out, something's going to die. Either the bonds are going to die, or the dollar's going to die. What's going to die if the Fed can't get out?
Well, I agree with the yet part. I mean, this will happen, but whether it's 2 years, 5 years, or 10 years, that's difficult to say. But get your gold now while you can at a very good price. Don't wait till the panic. But the point is, by the time the U.S. banks get around to acquiring gold and holding gold as a tier one asset, the horse will be out of the barn. I mean, gold will be going up, $100 an ounce per day, $1,000 a week. It'll look like the Bitcoin mania in late 2017, but it won't be Bitcoin. It'll be real. Yeah, there may come a time when big banks use gold as a tier one asset, but it'll be the gold will have skyrocketed before then. There'll be some kind of financial panic going on. There'll be a loss of confidence in the U.S. dollar, and everyone will say, "Get me some gold." What you'll discover in that situation, by the way, is you won't be able to get the gold, meaning dealers will be back ordered. The COMEX will probably be shut down because people long futures contracts in gold will be demanding delivery, and they don't have anywhere near enough gold in the warehouse. The last figures I saw were that what's called the open interest, the outstanding long contracts in gold, were 250 times the amount of gold in the warehouse. So they won't worry. They'll just close the contract, terminate use, send you a check for yesterday's price. You'll say, "Wait a second, I want tomorrow's price. I want today's price." They'll go, "Too bad. We're we're terminating this, and we'll send you a check for where we were yesterday." So that is not a source of supply. I'm enough of a geek that actually read the COMEX rule book. And if you read the rule book, and this is true for all the major futures contracts, it says we are not a source of supply. You can be long, you can demand delivery just to kind of keep the physical market honest. But if you think you're going to get your gold supply from the futures exchange, think again. So it won't be a source of supply. Mining output seems to have flatlined. I'm not a geologist. I don't have to get into peak gold, so-called, but I do look at the numbers. Global gold production by mines has not increased significantly for 10 years. In fact, it's decreased slightly in some years. So that seems to have plateaued, sort of flatlined. And more and more gold is coming out of the banking system. They can't even steal your gold because they don't have as much as they used to. It's going into private vaults. I talked to the head of precious metals of one of the largest private vault operators in the world in Zurich, Switzerland. It's a global firm, but I happen to be meeting with their head of precious metals in Zurich. And he told me that they cannot build new space fast enough.
Wow.
They're acquiring, the Swiss Army hollowed out all these mountains and built, forts and supply depots. And you look at a rock in the Alps, and it might actually be plastic. And if you move it off, there's an artillery piece behind it. So the Swiss are pretty well armed. But some of these facilities they don't need, and they're selling them to, among others, vault operators who are putting up multiple security perimeters and using them as vaults. So I said, well, where's all this gold coming from? He says it's coming from the banks. In other words, it's not new output. People are moving gold out of Deutsche Bank, Credit Suisse, UBS, and the big banks, and they're moving it into private vaults. So the amount of gold is the same, but people realize if you have your gold in a bank, it's subject to government confiscation with one phone call, whereas that's not true with the private vaults. So some people are ready for this, but as I say, the time to get gold is now, while the prices are reasonable relative to other asset classes, relative to the history of gold prices. Don't wait till the panic starts, because then it won't just be a question of price. It'll be a question of availability at any price. You won't be able to get it.
You have said in the past that the right number for gold is 10,000 an ounce. We've had these revelations. I've had Dr. Mark Skidmore on, the professor of economics and expert in public budgets from Michigan State University, who discovered 21 trillion in missing money at the DOD and HUD. I don't know if you want to talk about that, but boy, there's a lot of money out there if you just look at what they've printed up since the crash. And is $10,000 an ounce? Are you still standing by that? Could it be higher? Could it be lower?
It could be higher. I have trouble seeing how it could be much lower. But the point I make, Greg, and this is important, it's not a number I pulled out of the air. It's not a headline grabbing number. I'm not trying to get attention. I'm not a gold dealer, by the way. If people buy gold or don't buy gold, that's up to them. I don't get commissions. I don't really, I give the best advice I can. I give the best analysis I can. But if you don't want to buy gold, that's fine. That's up to you. As I say, I'm not a dealer. But the $10,000 is a mathematically derived amount. It's a pretty simple formula. You basically look at the base money supply. You can look at M0, M1, M2. I think it's interesting that the Fed has 4 different definitions of the money supply. It shows that they don't know what money is. But you just take M0, so-called base money, and look at it for all the major economies in the world. So European Central Bank, Bank of Japan, Bank of England, U.S., People's Bank of China. And then look at the physical gold. We know those numbers. There are 33,000 tons of official gold in the world. And assume that you're on a gold standard. Now, we're not on a gold standard. I like to say you can put yourself on a personal gold standard if you have cash or available assets, you can go out and buy some gold and put it in a safe place, and that's your own personal gold standard. But we're not on an official gold standard. But you have to ask yourself the question: what if we were? No central bank in the world today wants a gold standard, but what if they had no choice? What if there was a loss of confidence? What if there was a panic? What if the IMM special drawing rights didn't, get people calmed down and it was gold or nothing and you had to go back to a gold standard? The biggest mistake you could make is to get the price wrong. And that's what happened in 1925 when the UK and France and Belgium and others were going back to the gold standard after World War I. At least in the case of the UK, they got the price wrong. They went back to the pre-World War I price. But they had more than doubled the money supply in the meantime. So if you do that, you have 2 choices. You can either double the price of gold so it's in sync with the money supply, or cut the money supply in half so it's in sync with the old gold price. But they did that, and they went into a depression, 3 years before the rest of the world. So the people who say there's not enough gold to support commerce and trade and the money supply, I always remind them that's nonsense. There's always enough gold. It's just a question of price. Now, at the current level of around $1,300 an ounce, give or take, if that's too low. I mean, if you took the amount of gold at that price, right, it does not support the global money supply. But the question you have to ask yourself is, well, what price does? So if you take money supply, take 40%, so that would be the amount of gold backing, divide by 33,000 tons, that comes to $10,000 an ounce. Now, could it be higher? Sure. If you used M1 or M2, if you used a larger money supply, you would need a higher price. If you used a larger percentage, instead of 40%, what about 100% or 75%. That would be a higher price. So if you do that math, you can get to $40,000 an ounce easily. And again, I want to make it clear. These are actual calculations based on actual numbers that are publicly available for money supply and gold. It's not made up. It's not science fiction. It just answers a simple question. If you wanted to go to a gold standard today without causing deflation, given the amount of gold and the amount of money, what would the price have to be? And the answer on some very conservative assumptions of only 40% backing, not 100%, would be $10,000 an ounce. That's where the money comes from. When you say you're sticking to it, I'm sticking to it because it's math. I mean, again, it's not like a forecast who's going to win some election where you do have to update it. That math hasn't changed.
So coming back to the Federal Reserve policy of their dovish interest rates, and they're killing burning money, quantitative tightening. They're cutting that in half. They're pausing on interest rates, which you say is not enough. The gold market appears to be smelling blood in the water, and big players are like, okay, this is it. Ding, ding, ding. The bell has rung. Do you see it that way?
I do. I've actually been surprised that gold has done as well as it has, considering that the Fed has been tightening interest rates for almost 3.5 years at this point. Now you're right; they're on pause at the moment. But by the way, a pause, that means they're not going to raise rates. It's not quite the same as easing. I mean, if you were expecting them to raise rates and they said we're going to pause, okay, you can call that easing relative to expectations. I understand that, but they're not actually cutting rates. And they're not going to cut rates. And by the way, they're still tightening. I'm sorry, they're still tightening through the quantitative tightening. So cutting it from $50 billion a month to $25 billion a month, all right, that's less tightening. I understand that, but you're still tightening, and you're going to be tightening through September. And monetary policy acts with a lag, as I said. And so this slowdown in growth, this headwind for growth, is continuing. We're starting to see disinflation again. We've never seen inflation, not very much anyway. The Fed uses a particular number, personal consumption expenditure, year over year, core price deflator. That's the technical name for it, but just call it PCE. Their target for that is 2%. That's where the 2% target comes from. They got to 2% once in 7 years. It took almost 7 years to get there, and it immediately backed off to 1.9, 1.8. It looks like it's going down again, and I would expect that to continue. So there's no significant amount of inflation in the system. Disinflation, potentially even deflation, is a much bigger worry for the Fed. That's an awful environment for gold. Everything I just described, slowing growth, monetary tightening, disinflation, those are all bad things for gold, and yet gold has been going up. We're in a new bull market. Just a little historical perspective. We've had two great bull markets since 1971. See, prior to 1971, going back to 1933, there was no market in gold. We were the U.S. was pegged at $35 an ounce. Then you had Bretton Woods. It was still $35 an ounce, but they made it a more formal system. But even if you take that period from 1944 to 1971, when Nixon shut the gold window, you couldn't make any money on gold because it was fixed at $35 an ounce. When people bang the table and say, I want a gold standard, I always remind them, I say, you be careful what you wish for, because you won't make any more money in gold of gold's peg. The time to make money in gold is right now, when we're not on a gold standard and the price can go up. But be that anyway, from 1971 to 1980, you had the greatest bull market in gold in history. It went up over 2,000%, from $35 an ounce to $800 an ounce. Then from 1980 to 1999, you had a bear market, although the interesting thing about it is the price decline was at the front end of that, from about 86 to 99. Gold was pretty flat. It traded in a very narrow range. It moved around between kind of $200 and $450 an ounce. That's significant, but it didn't go to extremes in either end. It was pretty flat, and that was Greenspan, in my view, operating a shadow gold standard that was never admitted. But anyway, in 1999, the second bull market began. It ran until 2011. It went up over 700%. And then we had a bear market from 2011 to 2015, and it fell 50% from the $200 base in 99. So it went from 1,900 an ounce to $1,050 an ounce in December 2015, which if you use $200 as a baseline, not zero, but 200, that's a 50% decline. And then the new bull market began in December 2015 at $1,050 an ounce. Today it's over $1,300 an ounce. So that's close to a 30% gain so far in that bull market, which is about 3.5 years old. The problem, Greg, is that gold holders, gold investors, gold bugs, whatever you want to call people, they're so discouraged. They're so beaten down. They're so tired of waiting. They're so, they've just had enough. They can't believe it. Because of the length of the bear market from 2011 to 2015, or, heaven help you, if you bought it at $1,900 an ounce, you're down a lot, and it's been a very long wait. But that's exactly the time when you should buy. It's when sentiment is awful, everyone's discouraged, people hate it. That's the time to buy. Those are the lows. This is very contrary to human psychology. People always buy high and sell low, which is a wonderful way to lose money. But if you want to make money, you got to buy low and, at some point sell high, or at least hold on to it. Well, that low, we saw it. You can look at a chart, $1,050 an ounce on December 16th, 2015. It's been going up ever since. Now it's jagged, right? It's got volatility. There have been some highs and lows along the way, but nothing close to the 1050. So the bull market's intact. We're in the fourth year. Bull markets often start out slow. They start out slowly because of all the bad sentiment, all the bad memories, but then they gather momentum. So it's still not too late to jump on board this train, and my expectation is it'll pick up. But my point, going back to your question about the economy, if gold has done this well in an awful environment, an environment of raising rates and disinflation and weak growth, imagine how much better it will do if we actually saw a hint of inflation, which we may. And so I think we're just at that, the cusp, if you will, of much faster acceleration in this bull market, because the Fed, what the signal that the gold market is getting right now is that the Fed's throwing in the towel. The Fed tries to raise rates. They made some progress. They got from 0 to 2.25. Okay. They got the balance sheet down from 4.5 trillion to right now about 3.8, 3.9 trillion. So they made some headway. But two things happened. Number one, it came at a very high cost because they've slowed the economy. And number two, they can't continue it. They realize that they can't escape the room. And so now they're going to be desperate for inflation, and that's very bullish for gold.
Are we going to get at some point, I'd be remiss if I didn't ask you about this. We've heard about this even from Christine Lagarde at the IMF and other people. We've heard this over and over again for the last several years. A reset. A reset for you would be at least $10,000 gold. Are we going to get a reset anytime soon? Do you see a scenario where we could get a currency reset or a debt reset anytime soon?
Well, I'm surprised to hear Christine Lagarde talking about economics. She usually talks about climate change, but yeah, it's a very good point. I think something is coming. I think she's signaling that. It's funny, the elites. When I talk about global monetary elites, people, they hear that and they say, it sounds like some kind of deep, dark conspiracy. It's not. I mean, we know who they are. It's Jay Powell and Ben Bernanke and Larry Summers and Bob Rubin and Christine Lagarde and Mario Draghi, Mark Carney, Augustin Carstens. We know who they are. And they get together at either the BIS or the IMF has a couple of big meetings a year, or privately, or Davos, whatever. So it's a known group of individuals. They signal each other. So are they signaling us? Well, if you're astute and you know the coded language, again, they use a lot of words that have to be sort of interpreted between the lines a little bit. I always call the IMF transparently non-transparent. And what I mean by that, they're transparent in the sense that they put out a continual stream of press releases, studies, bulletins, updates, speeches, etc. But try reading them, and they're not in plain English. It make your head hurt, but you really have to speak their language to know what they're saying. But what's going on is that the elites are signaling each other. They're saying, get ready, it's coming. Now, when you say reset, there are lots of different kinds of reset. Now, going to gold, which I don't expect any central bank in the world or the IMF to proactively pursue that. At least not now, at least not until things get a lot worse. And that does imply the $10,000 per ounce price that I mentioned, perhaps a lot higher. But there are other kinds of resets. You could go to the special drawing right. That's the IMF money. I call it world money. You might ask yourself, well, why do they not call it world money? Because world money sounds kind of scary. They don't want to scare anybody, so they came up with this geeky phrase, special drawing right. But that's what it is. It's world money. The IMF can print it. They can print as much as they want. They can hand it out to their members. And if you have another financial crisis, which I do expect, worse than 2008, everyone's going to look to the Fed. But remember, the Fed has not normalized since 2008. They quadrupled their balance sheet and they cut rates to zero. And they've tried to get back to normal. They've made a little progress, but they're nowhere near where they need to be to bail out the world a second time. And so they're going to be limited in their capacity to solve the problem. And then you say, well, I like to recite the recent history or the litany. In 1998, with the long-term capital management crisis that I negotiated that bailout, I had a front row seat. In 1998, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. In the next crisis, who's going to bail out the central banks? It's the central banks that are going to come into play. And I had this discussion with Tim Geithner because I said, do you expect the IMF to use SDRs to reliquefy the world in the next crisis? And he kind of poured cold water on that and said, nah, we kind of tried that in 2009. It was clunky. It didn't work very well. And I said, well, the Fed's at the outer limit of what they can do with their balance sheet. I said, how are they going to reliquefy the world? And he paused for a second. He looked at me and said, guarantees. In other words, guarantees don't cost anything. You don't have to print money. You don't have to buy bonds. You just say, hey, all you people out there, you're worried about your money market funds. You're worried about your bank deposits. We guarantee them. And that's what they did do that in 2008. The FDIC insurance only covered $250,000. Well, there are plenty of small and medium-sized enterprises that have, $1 million in the bank or $2 million in the bank. It's, working capital, or they have it for a lot of reasons. And they were only insured to $250,000. So they were the ones lined up, pulling their money out of banks or spreading it among 10 different banks, et cetera. And the Fed said that's bleeding the system. So we're going to guarantee all deposits regardless of size. And they guaranteed every money market fund. The Fed did not have to do that. There's no FDIC insurance on money market funds, but the Fed created it out of thin air with a guarantee. So that's what Geithner and Bernanke and Paulson did in 2008. They just promised everybody it was all good. So what Geithner told me privately was that that's what they were going to do the next time. But I question that. I don't question their ability to do it. Legally, they can. I question whether it will work. Because the next crisis is not going to be a panic over Wall Street. They're all too big to fail. It's going to be a panic over the central banks themselves or the creditworthiness of the United States itself. And if you're the one who's in distress, you're the one people are losing confidence in, how good is your guarantee? In other words, when people say, well, I have insurance for this or that, okay, have you checked out your insurance company? How good is the insurance company that's giving you the insurance? Are they going to be there when you need them? Are they AIG? And so I'm not sure guarantees will work because the person giving the guarantee is going to be the one who's in distress. And so now you do turn to the IMF, and that's one kind of reset. Now, I'm sure that's what Madame Lagarde has in mind. I question whether that will work. At the end of the day, when things get bad enough, you have to go back to gold. It's not magic. It's not because it's shiny. It looks pretty, but that's not the reason for it. The reason for it is it's the only asset, it's the only form of money in which people have confidence that doesn't rely on anybody else.
And then you just have to get the price right.
And you have to get the price right. Well, if you're not on a gold standard, the market will get the price right. And that'll be $10,000, $20,000, $30,000 an ounce. But if you do want to go on a gold standard, you're going to have to start at 10,000, maybe higher.
What about silver? Silver. I always ask the silver investor. We talk about gold a lot. Silver. Jim Sinclair says that silver is going to be gold on steroids. It's going to go absolutely crazy. Other people have said, yeah, they've been suppressing it so much. I mean, we're at mining costs. It's going to go way higher in terms of percentage basis. What do you say about silver?
Yeah, look, I'm not anti-silver. I invest in silver. I think silver Silver will tag along with gold. I don't think it's gold on steroids. I follow, well, I should, well, follow. Yeah, every now and then I look at some of the the silver conspiracy theorists, the people who say, J.P. Morgan's got, a zillion tons in their basement and they're suppressing the price. I mean, I think a lot of those people don't really understand how these commodity markets work. You can't just look at the COMEX report and think that how much silver somebody has, because you don't know. They could be short in derivatives markets that are non-transparent. They could have silver swap agreements. They could have forward sales. They don't have to be acting for their own account. They could be acting for the account of customers, and they could have physical silver someplace. You have so many elements that go into it, most of which you don't know. They're non-transparent. That I would be hesitant to kind of project these silly silver prices. Having said that, I'll say, by the way, the other difficulty in analyzing silver that you don't have in gold is that silver is an industrial commodity. It's used in tons of things, automobiles and electronic applications, and it's alloyed. It's just used in a lot of things. Gold isn't. People talk about the industrial uses of gold, and you look into that, and you find out you're talking about jewelry. Well, there's no difference between jewelry and bullion. I mean, jewelry is wearable wealth, and bullion, you put it in a safe place, but there's still forms of wealth preservation. So gold actually has almost no uses except money, and it's the best form of money. So gold has a role. It's called money. It's money. It doesn't have to do anything else, but it makes it easier to analyze, because all you really have to look at are mining output, official gold, money supply, some of the things I'm talking about. The jewelry is just an adjunct of bullion, as far as I'm concerned. Silver is different because it does have these industrial uses. But having said that, it's not like gold's going to go to even $5,000 an ounce, and silver's going to sit there. Silver's going to tag along. There's every reason. There are as many reasons, I should say, to be bullish on silver as gold, but I don't think it's going to perform at some multiple in percentage terms. But here's the thing: you need American silver eagles, or some kind of. I like American silver eagles because they're from the U.S. Mint. They say, "In God we trust." It's a real coin. It's not some slug that somebody printed. It's not or stamped out. You don't have to worry about the quality of it or counterfeiting and all those good things. But everyone should have a monster box. A monster box is a 500 1-ounce silver coins. Wow. You can get them from the U.S. Treasury, from the Mint, but the Mint is part of the Treasury. They come in a nice dark treasury green box. There's actually a compression strap around it, so they're bonded. Don't open the strap unless you need the silver, because that's a good way to have it in case you ever want to sell it. But my point being, people have batteries, flashlights, and water for hurricanes. You should have a monster box too, because when the electricity goes out, which it seems to be doing with increasing frequency, given the complexity of the grid and hacking and storms and other events, with no electricity, guess what? The ATMs don't work. The banks are closed. The credit card machines don't work. You can't use digital credit in any form because it all relies on electricity. But a 1-ounce silver coin will feed your family. So I recommend that in an extreme crisis, because gold's going to be too much. You walk out with an ounce of gold, try to buy groceries. That's like a year's worth of groceries. You can't. You're going to be sitting there with a little chisel knocking off a piece of the gold. Whereas silver is just about the right amount to purchase, a couple of bags of grocery, or go down to a local farm, or get some bacon and cheese, or whatever they have on apples, whatever they have on offer, to feed your family, or a store, or a merchant, or people set up. They'll have a public square. They'll be in Union Square in New York with tables of fresh fruit, but they'll only be taking silver coins. So you should have silver for emergencies. It will tag along with gold. I do like it, but I don't buy into some of the more extreme scenarios.
Okay, I want to talk about your book, but before we get there, because this says aftermath, and I want you to talk about what happens before we get to the aftermath. I mean, evidently you're saying, you've already said that the next crisis is going to be far worse than '01 or 2000 and 2008. Well, set us up before we get to your book on what do you see coming in terms of crash or strife or gnashing of teeth. What do you see?
Well, I'll be happy to do that, Greg. But before I do that, I want to just remark that you have something I don't have, which is a copy of the book. Obviously, I
I,
wrote the book.
I know.
I wrote,
Yeah, I got to tell you, it came just before. I mean, literally just before I was counting down to the interview. I got your book because I could. Even your person that set up, Allie, said, "Well, we don't have the book yet. We'll try to get it to you as soon as we can." Well, she came through, so give her a gold star for that. But this is the book. It's the galley copy. Of course, your books you always get your money's worth. I mean, it's huge. There's tons of footnoting. I mean, pages and pages on a couple, 3, 4, 5 dozen pages. But anyway, what do we have before we get to the aftermath? What's the biggest crash in history? I guess. I mean, you tell me what it is.
well, the important thing to understand this book, Aftermath, the publication date is July 23rd. It is available for pre-order on Amazon and Barnes & Noble right now, so you can go order it. But you won't. It'll come. It'll be in your mailbox on or, your doorstep on July 23rd. What you have is called a galley. We send those out. We send them to publicists, reviewers, etc. And they put them in the mail yesterday. Mine hasn't come yet. It might be in my other house. But the point being, you got it. I don't. So I'm very, very envious of you. But there it is. So this is volume 4 of what I call the International Monetary Quartet. It's a 4-volume work. I've been working on it since 2010. So the first book was Currency Wars. Second book was The Death of Money. The third book is The Road to Ruin. And the fourth book is Aftermath, which is the one you're holding. I also wrote The New Case for Gold. That's an important book, but that's not part of this quartet, this International Monetary Quartet. So you're actually holding the galley for volume 4, which completes the quartet. And in the earlier books, Currency Wars had a lot of history. It went back to the classic gold standard beginning in 1870 and traced through the history and kind of brought readers up to date. The Death of Money was a tour of the world, so I went around Germany, China. IMF showed how all the pieces fit together. The Road to Ruin took you into the crisis. It's okay, now you're in the crisis. Here's how first 2 books warned you with background. Volume 3 puts you in the middle of it. Here's what's going to happen. Here's what you need to do. Volume 4 takes you through that. It talks about what the world will be like after the crisis. It talks about the reset. Now, it also talks about a lot of things that are going to cause the crisis that I haven't talked about in the past. There's a whole chapter on passive investing. You love your index funds with low fees. Well, guess what? So does everybody else. And if everyone's in an index fund and there are no more active investors, who's committing capital? Who's setting prices? Where's the price discovery? Where's the liquidity? There isn't any. Everyone's on the same bandwagon. It's going to roll downhill and nothing's going to stop it. So this passive investing, it's like a parasite. The first parasite that lands on the back of the elephant has a full meal, plenty to eat on that elephant. And then another one and another one. But eventually you get so many parasites sucking the elephant dry that the elephant dies and the parasites die too. And that's a good metaphor for the financial system. The first, Jack Bogle died recently. He was the founder of the first low-cost mutual fund that was an index fund that basically just followed the market. And it was great for investors. You got the low fees and you got market performance, and over the long run, it has been up. But then more and more funds, ETFs are kind of mini index funds, et cetera. So if everyone's indexing and no one's committing capital, what's happening is that the parasites are killing the elephant and the whole thing's going to fall over. So there's a chapter on that. There's a chapter on behavioral psychology. I think we're all pretty familiar with that. People have biases. You can identify the biases experimentally. With education, you can kind of overcome them. But what's been happening is something called choice architecture, where the psychologists are now working hand in glove with the economists to manipulate your behavior in ways that you don't understand. And I talk about 401ks and IRAs and many other aspects of life where we are being manipulated, 24/7, using psychological biases that most people are barely aware even exist. So I kind of unlock that, expose that. I'm not against science. I think behavioral psychology is a great science, but it's like nuclear fusion. Are you using it for good purposes, maybe to generate energy, or are you using it for bad purposes to build thermonuclear weapons? And so that's behavioral psychology. There's a chapter on the debt and deficit. It's different than most people expect. Most people think that, the debt has just gone up over the entire history of the United States, from George Washington to Donald Trump. That's not true. The total debt has gone up, but it goes in a cycle. It goes up and down and up and down. What happens is we run up the debt to fight a war, then we win the war, and then we bring the debt down to get back to normal. So you have a little dry powder, so you can do it again. What's different about the period since 2000, and that, by the way, what I just described was true through the Clinton administration. Bush 43 blew off the lid, doubled the deficit. Obama doubled it again. So Bush added, when Clinton left office, the debt was about $5 trillion. Bush 43 added $5 trillion, so he doubled it. Obama added $10 trillion, so he doubled it again. So instead of kind of winding it down through peacetime, as we had always done throughout our history, starting with George Washington, you had two presidents in a row who doubled it down. And so far, Trump is on his way to $1 trillion deficit. So now we look more like Italy. We're a little bit behind Greece, but we're catching up with Italy, and that's going to cause problems of its own. Because again, what happens if you actually need debt finance? What happens if you're actually in a war or a natural catastrophe, natural disaster, something where, where severe depression, financial panic, some place where arguably you do need to run up the debt and the deficit? How are you going to do that if you're already maxed out, if you never took the prudent step of reducing it when you could? And we have not. So there are individual chapters on these things, but the thread that runs through them all is that here are a set of things that are leading to this catastrophe that I'm describing. You should be aware of all of them. And I also make the point that we're not helpless. We don't have to just sit there, watch this develop, and watch our wealth destroyed. There are concrete things that you can do today that will, first of all, perform well, but also preserve wealth when the crisis comes. And that's why we say, seven secrets to wealth preservation in the coming crisis. So it's not just a forecast of the crisis, but it has concrete tips, concrete things that you can do to preserve wealth. And then finally, it tells you what life will look like after this crisis. That's what I mean by the aftermath. I don't know what my next book is going to be, but I've probably said all there is to say on the international monetary system. But I hope people who have not read my books enjoy the new one. I hope people who have read my books, first of all, thank you. But this will complete the quartet. It'll complete the story. And as I say, it'll be out soon. You can pre-order now, and I hope people enjoy it.
How bad, when you say this is going to be the worst ever, and I'm not trying to just, the sky is falling, but, for a guy like you to say this is going to be worse than 2000, which was pretty bad, and worse in 2008 when they printed money like cuckoo time and still doing it, how bad does this have to get to be the worst ever?
Well, it has to get bad enough to the point. Again, these are things I talk about in The Road to Ruin, where they actually freeze the accounts. In other words, it's not a question of, we guarantee your deposits, because people are not going to have confidence in the guarantee. So then they're going to have to freeze the accounts, close the exchanges, shut the banks. And by the way, this has happened recently. All of these things have happened before. None of them are science fiction. In Greece in 2015, people were flying from Athens to Munich or Berlin, loading up suitcases with physical paper euros, and flying back so they could have money. Why? The banks were closed, the ATMs were closed, the credit cards didn't work, the debit cards didn't work. You were, if you didn't have money in your pocket, most people didn't, it was either barter or get out of the country, get some euros, and come back. So same thing in Cyprus in 2013. These things have happened recently. Try using an ATM in Venezuela. I was in Mexico at the end of December. The ATMs were shut down. It wasn't a nationwide panic, but it's like, oh, that's interesting. I can't get any cash right now. I got to get in a taxi and go to the next town. So these things are happening all over. 1933, FDR shut the banks. In 1914, the New York Stock Exchange was closed for 5 months. Hurricane Sandy, ATMs didn't work, et cetera. So all these things have happened. But they'll happen again on a much larger scale, because the promises won't work, the money printing won't work, the guarantees won't work. They'll have to just shut it down. Now, they'll say to you, well, we're not stealing your money. You still own it. We're not stealing your stocks. You still own them. You just can't trade them right now. Well, that converts publicly traded equity into private equity. Well, if you're a private equity investor, you don't expect liquidity. You hope for good returns. It's risky, but you don't think you can get your money out. You don't think you can get your money in less than 4 years or 7 years or whatever it is. So they'll turn publicly traded equity into private equity and say, "Sit tight. We'll get back to you with the solution."
Wow.
Well, the solution is going to be something like the SDR. So my point being, it's not so much. So that's worse. That's a lot worse than what happened in 2008. But I should be clear, Greg. I'm not talking about the apocalypse. I'm not talking about the world burning to the ground. I'm not talking about the end of the world. People like to put words in your mouth, and they'll say, "Oh, Jim Rickards says the apocalypse is coming." I've never said that. I don't believe that. But I do believe it will be radically different. And this is what I talk about at the end of the book. What life will actually be like. And I give some concrete examples. By the way, the people with the machine guns and the canned goods and the caves, that's not the solution either. There are solutions, but it'll look a little more like the late 19th, early 20th centuries than it does the 21st century.
Jim Rickards, we've been on 50 minutes. I've given quite a tour de force here, quite a workout. I want to hold the book up again. Again, you can go on. Well, put links up to wherever you want me to link to in the pre-order. You can pre-order the book Aftermath, and of course, I've got most, if not all of them. I've got Road to Ruin. You can buy all of his books and actually just read them, binge out and read them sequentially. I love this book. I think that's going to be part of the fix. And then, of course, Currency Wars. And your latest book, the final in the quartet, Aftermath. Jim Rickards, thanks for joining us today on USAWatchdog.com. Fascinating guy. Always love listening to you. You always give a great perspective that's just a little bit different with some great stories of people you meet along the way. Jim Rickards, thank you so much for joining us today on USAWatchdog.com.
Thanks, Greg.